Okay, so you want to own a McDonald's franchise. You've done the math in your head. Millions of people walk through those doors every day. The brand is everywhere. People eat there in recessions, in snowstorms, at 2 in the morning after a concert. The Golden Arches are arguably the most recognized commercial symbol on the planet. You buy in, you hire some managers, the machine runs, and the money flows back to you. Sounds simple. It is not simple. Here's what actually happens. You write the largest check of your life, possibly multiple checks, before you flip a single burger. You spend the next 12 to 18 months in mandatory training, learning to mop floors and close registers and manage overnight staff. Then you open your doors, and a significant portion of every dollar that walks in the building doesn't belong to you. It belongs to the system, the brand, the landlord. And here's the part that most people never figure out until they're already in. In many cases, the landlord is McDonald's Corporation. That's the real story here. Not whether McDonald's is a good franchise. By most measures, it is. The real story is what you are actually buying, who benefits most from your investment, and precisely how the math has to work for you to survive. Because the structure of this business is far stranger and far more lopsided than it appears from the parking lot. Let's start by reframing the entire thing. Most people assume McDonald's is a restaurant company that uses franchising as a growth strategy. That's not quite right. McDonald's is, at its core, a real estate company that happens to use restaurants to generate the revenue that pays its rent. This isn't a metaphor. It's not an oversimplification. It's the actual thesis that runs the company. Harry Sonneborn, McDonald's president from 1955 to 1967, said it plainly. We are not technically in the food business. We are in the real estate business. The only reason we sell hamburgers is because they are the greatest producer of revenue from which our tenants can pay us rent. That line wasn't a joke. It was the strategy. Sonneborn is the person who convinced Ray Kroc to stop trying to collect supply markups from franchisees, which wasn't working, and start buying the land under the restaurants instead. In 1956, they created the Franchise Realty Corporation specifically to acquire and lease restaurant sites. McDonald's would buy or lease the land, build the restaurant, and then sublease the whole thing to the franchisee at a markup. The franchisee would pay rent and royalties. And if the franchisee didn't comply with brand standards, McDonald's didn't need lawyers. It just needed to be a landlord. This is the lens through which every number in this video has to be understood. When you buy a McDonald's franchise, you are not just buying the right to serve Big Macs. You are renting a seat inside someone else's real estate empire. And that empire has spent 70 years optimizing the lease terms in its own favor. So what does it cost to get in? According to McDonald's own franchise disclosure document, a legally required document that every prospective franchisee receives, the total initial investment for a traditional U.S. restaurant ranges from approximately $1.47 million to $2.73 million as of recent filings. That's a wide range, and where you land depends on the restaurant format, location, and whether you're buying an existing store or building a new one. That range does not include the land. McDonald's typically owns or controls the land and building. What you're paying for is the equipment, the interior build-out, the signage, the technology systems, the opening inventory, and the initial franchise fee, which is a flat $45,000 for a 20-year term. If you're taking over an existing restaurant, you'll pay approximately 25% of the purchase price in cash up front. For a new restaurant, it's 40% of the total project cost, also in cash. Not financing, not debt, cash. McDonald's also requires you to have a minimum of $500,000 in liquid assets before they'll consider your application. The corporation wants to know you can survive the startup period, absorb early losses, and fund the inevitable remodel cycles without coming back to ask for help. Here's where the tiers matter. A smaller satellite location, say inside a hospital or university campus, might sit at the lower end of that investment range, closer to $1.5 million. But it also generates far less revenue. A freestanding traditional restaurant with a drive-through in a strong suburban or highway location can easily push toward $2.5 million in startup costs. And since roughly 93% of McDonald's locations are franchised, you're competing with a large pool of existing operators for the best available slots. Before you open, the clock is already running, and it's running expensive. The training program alone takes 12 to 18 months. You are not running your own business during this time. You are working in existing McDonald's restaurants, learning every role, every system, every standard. This is mandatory. There is no waiver. During that period, you're living off whatever savings you had before you started, because your restaurant isn't open yet and you have no income from it. Beyond the time cost, there are hard costs that catch new operators off guard. You'll need general liability insurance before you open. Industry estimates put this in the range of $10,000 to $30,000 per year, depending on location and coverage. You'll need to fund payroll for the weeks of soft opening operations and staff training before revenue stabilizes. You'll pay permitting and licensing fees that vary widely by municipality, but can easily run $5,000 to $20,000 in a major market. If your restaurant requires any environmental review or zoning variance, common in developed markets where new sites are scarce, add legal fees on top of that. And then there's the remodel clause. McDonald's periodically requires franchisees to renovate their restaurants to meet current brand standards. This is not optional. These mandatory remodels can cost anywhere from $300,000 to over $700,000 depending on the scope, and they are financed by the franchisee, not McDonald's. They improve the asset, which McDonald's owns. This is the dynamic that critics of the franchise model point to most often. You pay to upgrade a building you don't own, so that the company that does own it can lease it back to the next operator at a higher rate. Now let's talk about revenue. Because the numbers sound impressive right up until you apply the actual cost structure. The average U.S. McDonald's restaurant generated approximately $4 million in annual gross sales in 2023, according to the company's own franchise disclosure document. That's the highest it's ever been. The median was around $3.84 million. Roughly 79% of domestic traditional locations exceeded $3 million in annual sales. That's the headline number. Here's what it's actually made of. The first and largest revenue stream is the drive-through and in-store food and beverage sales. This is the obvious one. Burgers, fries, drinks, breakfast items, McNuggets. At a typical $4 million location, the vast majority of that revenue, perhaps $3.6 to $3.8 million, flows through this channel. The margin on individual food items varies enormously. Fries and soft drinks are high margin. Sandwiches and specialty items carry more food cost. Industry operators describe the product mix using what's sometimes called a 30-30-30 rule. Roughly 30% of revenue to wages, 30% to site costs, rent, utilities, maintenance, 30% to food and paper costs. That leaves 10% for everything else, including your franchise fees. The second revenue stream is the beverage category, specifically McCafe. McDonald's has aggressively expanded its coffee and cold beverage lineup over the past decade, and beverages carry margins that dwarf the rest of the menu. A large iced coffee that costs under $1 to produce sells for $3 to $4. At scale, this matters. A restaurant doing $4 million in annual sales might generate $400,000 to $600,000 from beverages alone, with a significantly higher profit margin than food. The third stream is the digital channel. Mobile orders, loyalty program redemptions, delivery partnerships. McDonald's has invested heavily in its app and loyalty ecosystem. Digital orders tend to carry slightly higher average ticket values because customers browsing an app add items they wouldn't have ordered at a counter. This channel now represents a growing slice of total sales at high-performing locations. And the fourth is simply throughput volume, especially the drive-through. A busy McDonald's drive-through can process several hundred cars per hour. At an average ticket of $10 to $12, that's a significant revenue stream that can be maximized or destroyed by staffing, equipment, and location quality. Here's what you need to understand about all four of these streams. McDonald's takes a cut of every single one of them. Not a cut of the profit, a cut of the gross sales. Before we get to what you keep, let's be very clear about what leaves before you touch it. McDonald's charges a service fee, royalty, of 4 to 5% of gross sales, depending on your franchise agreement. For new agreements signed in 2024 onward, that rate moved to 5%, the first increase in nearly 30 years. On a $4 million store, that's $160,000 to $200,000 per year, going back to corporate, off the top, before you've paid a single employee. McDonald's also charges a marketing and advertising fee of at least 4% of gross sales, again on total revenue, not profit. That's another $160,000 on a $4 million location, going to fund national campaigns, digital platforms, the app, and promotional programs. You don't control this money. You don't decide how it's spent. You contribute it. Combined, the royalty and advertising fees alone represent 8 to 9% of gross sales, roughly $320,000 to $360,000 per year on an average performing U.S. restaurant. And then there's the rent. McDonald's owns or controls the underlying real estate at the majority of its U.S. locations. As the landlord, it charges franchisees rent that typically runs between 8.5 and 15% of gross sales, with the average landing around 10 to 11%. On a $4 million store, that's $400,000 to $440,000 per year flowing back to McDonald's real estate arm before you've calculated food costs or labor. Add it up, royalties plus marketing plus rent. That's potentially $720,000 to $800,000 per year, leaving a $4 million restaurant and going to the corporate entity. You haven't bought a single pound of beef yet. Now add the actual operating costs. Labor is the biggest variable. A typical McDonald's runs with a crew of 50 to 80 employees depending on operating hours and volume. At current wage rates, which have climbed significantly across most U.S. markets, payroll and benefits for a mid-volume location runs approximately $1.1 million to $1.3 million per year. The federal minimum wage has been $7.25 since 2009, but most operators are now paying $15 to $18 per hour or more, driven by state and local laws and labor market competition. In California, where a statewide fast food minimum wage hit $20 per hour in 2024, labor costs for McDonald's operators pushed substantially higher. Food and paper costs run roughly 28 to 32% of food revenue, which translates to approximately $900,000 to $1.1 million on a $4 million store. You purchase from approved suppliers through McDonald's supply chain network. This is not negotiable. You don't go find a cheaper beef supplier. You buy from the approved vendor at the approved price. Utilities, gas, electric, water, run approximately $80,000 to $120,000 per year for a traditional freestanding restaurant. Equipment maintenance and repair adds another $30,000 to $60,000 annually. Insurance beyond the basic liability coverage, property, workers' compensation, umbrella coverage, can total $40,000 to $80,000 per year. And then there are technology fees, the point-of-sale system, the digital ordering kiosks, the app integration, the loyalty platform. McDonald's has been aggressively rolling out new technology, and the costs of maintaining and upgrading these systems fall largely on the franchisee. Run all of this through the calculator, and what comes out the other side, after rent, royalties, marketing, labor, food costs, utilities, insurance, maintenance, and fees, is a net profit margin somewhere between 6 and 15%, with most operators landing in the 8 to 12% range in a reasonable year. On a $4 million restaurant, that's roughly $240,000 to $480,000 in operating income before taxes and debt service. Various industry analyses and Glassdoor data suggest the average McDonald's franchisee takes home somewhere around $150,000 per year after accounting for all costs and debt payments. That sounds like a decent income. The question is what it cost you to generate it. Here's the structural risk that nobody walks you through when you're in the application process. McDonald's franchise agreements run for 20 years. There is no automatic renewal. At the end of your term, you go back to McDonald's and negotiate a new agreement. Or you don't. McDonald's makes this decision. You have no contractual right to continue. You have invested $2 million, operated the business for 2 decades, renovated the restaurant multiple times at your own expense, and at the end of it, you require the franchisor's approval to keep going. But here's the deeper structural risk. Your franchise agreement does not guarantee territory protection. McDonald's is explicit about this in its own franchise disclosure document. It states clearly that franchisees receive no designated territory. The agreement contains no right to exclude the location or development of future McDonald's restaurants nearby. McDonald's can open another location down the street, or license a new operator 2 blocks away, or add a kiosk inside a grocery store across the parking lot. And your franchise agreement provides you no recourse. This isn't hypothetical. In fact, it was one of the documented causes of collapse in a real case from Des Moines, Iowa, in 2016. The Brown Customer Delight Group, or BCDG, a 6-unit McDonald's franchisee that had once operated 10 locations in the area, filed for Chapter 11 bankruptcy that November. In their own bankruptcy documents, BCDG cited 2 primary causes of their financial decline: increased competition from other fast food chains, and McDonald's construction of new company-controlled restaurants that pulled sales away from BCDG's existing locations. Let that land. A McDonald's franchisee, destroyed in part by McDonald's opening more McDonald's restaurants nearby. BCDG's 6 remaining restaurants had generated $7.6 million in sales through August of that year, but sales had fallen by $4.5 million compared to 2015, when the company had already recorded a loss of just under $900,000. By the time they filed, the company reported $6.7 million in assets against $15.6 million in liabilities. The debt included a $6.1 million obligation to Citizens Bank. The company had gone from 10 locations to 6, sold off units to try to stabilize, and still couldn't outrun the hole. Here's what makes BCDG's case a particularly useful example. It illustrates the leverage asymmetry in the franchise relationship. McDonald's moved to terminate BCDG's franchise agreement in August 2016. The same month, the operator filed for bankruptcy protection, which effectively handed control of the process to the courts. The filing was, in some sense, the last move available to a franchisee who had exhausted every other option. Former McDonald's operator and consultant Richard Adams described the general dynamic this way: when a franchisee is struggling, the best option is usually to sell to another franchisee and hope that after debts are settled, there's something left. Filing for bankruptcy hands all control to the courts and to the company. Once the real estate, which McDonald's owns, is accounted for, the franchisee is often left with very little. Let's put 2 scenarios side by side, built from the numbers we've already established. In the good year, your restaurant generates $4.5 million in gross sales, above average but not exceptional. Royalties and advertising fees at 9% come to $405,000. Rent at 10% is $450,000. Food and paper, at 30% of food sales, is approximately $1.26 million. Labor, including benefits, runs $1.2 million. Utilities and maintenance, $150,000. Total operating costs, approximately $3.57 million. Operating income before taxes and debt service, $930,000. After federal and state income taxes, assuming an effective combined rate of around 30%, and after annual debt service on the original acquisition loan, you net somewhere in the range of $380,000 to $420,000. That's a strong year. You're paying down your investment, you're making a real income, and the business is stable. In the bad year, sales fall 15%. A bad local economy, a new competitor nearby, a public health scare, a staffing crisis that hurt your service scores. Your restaurant does $3.8 million in gross sales. The rent is still 10%, $380,000. The royalties and marketing are still 9%, $342,000. Your labor costs don't fall proportionally, because you can't eliminate fixed staffed hours. You're still running $1.115 million in payroll. Food costs scale somewhat, $1.05 million. Utilities and maintenance are largely fixed, $150,000. Insurance, $100,000. Operating income, $630,000. After taxes and debt service, you're looking at $180,000 to $220,000. The difference between those 2 years is approximately $200,000 in take-home income. And critically, your debt service doesn't change, your rent doesn't change, your royalty rate doesn't change, fixed costs are immovable. When revenue drops 15%, your take-home income can drop 50% or more, because so many of your costs are locked in regardless of volume. And if sales dropped 25% instead of 15%, you'd be in BCDG territory. You'd be covering your obligations with reserves, taking on debt, and running out of runway faster than you might imagine from the outside. So why do people still do this? Why do sophisticated operators still invest $2 million into a structure this leveraged, this fee-heavy, this asymmetric? Several reasons. First, the brand is genuinely powerful. An average U.S. McDonald's does $4 million a year in sales, a figure that most independent restaurants, including very good ones, will never approach. The customer base is pre-built. The marketing machine is relentless. You are not starting from zero brand recognition. You are starting from the most recognized fast food brand in human history. Second, the real estate appreciation argument. Even though you don't own the building, successfully operating a McDonald's in a strong location for 20 years is a business asset with real resale value. Multi-unit operators, those with 3, 5, or 10 locations, build substantial enterprise value. McDonald's itself reports that when franchisees exit the system, the transfers are usually orderly. There's always another qualified buyer waiting. Third, there is a tax argument. A properly structured franchise operation, especially one with significant depreciation on equipment and leasehold improvements, generates tax deductions that reduce the effective take-home income figure. Owners who roll profits into growth, adding a second or third location, can defer tax obligations while building scale. Fourth, scale itself changes the math. A franchisee operating 10 locations can negotiate better with suppliers, spread management costs across more revenue, and absorb bad years at one location with strong years at others. McDonald's as a system favors multi-unit ownership. The economics of one location are real but modest. The economics of a well-run portfolio of 8 to 12 locations can be genuinely substantial. But none of this changes the underlying architecture. The fees come first. The rent comes first. The royalties come first. You, the operator who bore all the financial risk, who put up the $2 million, who managed the employees and the health inspections and the equipment failures and the negative Yelp reviews, you get what's left. Return to the reframe we established at the beginning. McDonald's is not a burger company, it is a real estate company. And when you buy a franchise, you are not buying a business that you own. You are buying a seat in someone else's building, under someone else's lease terms, selling someone else's product, to the specifications of someone else's operations manual, for 20 years, with no guarantee of renewal and no protection from your own franchisor opening a competing location next door. That is not a pitch against McDonald's franchising. For many operators, the system works, and works well. The brand's durability is real. The training is genuinely comprehensive. The supply chain is efficient. The marketing is among the most effective in the world. Over the life of a 20-year agreement, a well-located, well-managed McDonald's franchise can generate millions of dollars in cumulative income. But the structure is the structure. The math is the math. And the math says that in a good year, roughly 20% of your gross revenue leaves the building before you've bought a single pound of beef, flowing back to McDonald's Corporation through rent and fees. It says that your largest single fixed cost, rent, goes directly to enriching the entity that holds ultimate power over whether your business continues to exist. It says that the corporation's interest and your interest are mostly aligned, except when McDonald's decides it wants to open another location in your market, or require a remodel you can't fully afford, or simply not renew your agreement when the 20 years are up. What you're really buying, underneath all the Happy Meal marketing and the global brand recognition, is this: the most expensive tenant-landlord relationship in fast food. The golden arches are golden, just not always for the person standing under them.